Time and time again, we get financial statements, non-GAAP accounting, revisions and revised statistics, and a long list of financial figures that expose the reality about how manipulated they can be. Calculations for certain metrics change, so comparing historical data is proving to be difficult. As more central bank intervention takes place, the facts are obscured, and those in control can easily pull the rug from underneath passive investors. You came here for the truth, so let me unveil that for you. Today we're going to talk about the sea of lies. The economic data gets released on a monthly, quarterly, annual basis. All of this is put together by those in the mainstream media, and they present you a rosy picture. Even throughout the financial crisis, we were getting data that was showing the consumer is doing well. There was just a brief period where they had said that things were looking a little rocky, but don't worry because next year it will be fine. And then the year after, they said, don't worry, it will be fine, and so on. And of course, today we are seeing the exact same repeated lies. I'm going to show you the details of this report and break it down. Let's get into it right away. GDP slows to 2.1% in the second quarter but beats expectations thanks to a strong consumer. Strong consumer. That's an interesting term because when you use that term, it is suggesting that what the consumer is doing, their habits are good. They are actually going out there and they're investing, they are buying, and they are doing so conservatively and well within their means. But of course, that isn't the case. Let's go further into it. Data for the second quarter of 2019, also released Friday, showed that the economy expanded at a 2.1% annualized pace above the median projection that followed a 3.1% reading in the prior 3 months. This information came out, and because of the expectations, it's always based on expectations, just like the earnings. People have been talking about how great the earnings have been doing, and it's funny because all of these companies simply reduce their expectations of earnings, and then they can exceed that. It's a bar that is so easy to jump over that most investors are buying into all of it regardless. So of course they'll do this. They'll do this time and time again. They always make it very easy to climb above those expectations. Here we are yet again. GDP personal consumption has hit a level it hasn't been at in several years. We are getting the same repeated patterns over and over again. Debt is at the highest levels it's ever been. Deficits are soaring. We are seeing the same problems that are in this cycle that is simply repeating, and unfortunately it doesn't end well. We saw the same type of behavior going on leading up to the financial crisis. We are using this maximum amount of leverage. Margin is out of control, and we are seeing this definitely on all levels, whether it's in the government, whether it is from the individual. Personal consumption spending growth in the second quarter of 2019. So I told you that the strong consumer was the reason why the GDP grew at the level that it did. Here you can see something very interesting highlighted in the top. Recreational goods and vehicles. Very interesting. RVs are the reason why this has surged to this level. Very unusual as far as I'm concerned. We're talking about this right now coming at a time in which they should be going down. I'm going to show you data that would prove that this right here, this individual line, is very, very suspicious. Total revolving credit owned and securitized. You could see that credit card usage has hit a record high yet again. The exact same thing happened in the previous cycle, before that, but I'm just showing you here the financial crisis and what happened. This does not come down until after the recession is on. People are starting to realize, this isn't a temporary issue, this isn't a blip, this is actually happening, and you could see that it will, of course, result in people having to leverage because of bankruptcy, because of changing in habits. They're forced to. This is going to happen, of course, yet again, as we see throughout all of the previous cycles. GDP government spending has increased to a level it hasn't been at since the financial crisis. The amount of money being spent here on every level is absolutely astronomical. This is good because it shows you the quarterly GDP breakdown by component, and that just shows the personal consumption expenditure expenditures, the exports, fixed investments, imports, and so on. You can see that exports were hurt here. That's obvious. Strong US dollar. We've got the tariff issues. We've got the geopolitical tensions that are happening now. That really pulled it down a bit. But of course, we have had this personal consumption expenditures that have brought this up considerably. Now you're looking at this credit card usage, the expansion of debt and deficits as being something that is fantastic, that has helped out the economy. However, this data here from this article, something I grabbed a few days ago, I haven't had a chance to do a video about it, but when you look at this, it really paints a different picture than the data I showed you a moment ago. The RV industry is a great bellwether of the economy. Because the vehicles are an expensive and discretionary purchase, easily delayed by consumers who start to worry about their financial stability. If people don't have the money, they're not going to buy a nice brand new RV, they're not going to have increased sales. You would see the companies that are affected by this. But we just saw the data that came out suggesting that RVs are going up and they're looking hot. Something's weird about that. The tariff price increases are what tipped the RV business. It started a landslide, no question. This data is coming from those directly in the RV industry, and I want to show you the chart that corresponds to that information. RVs and recessions. RV sales can be an economic bellwether because such vehicles are highly discretionary, easily delayed in hard times. A sharp decline in manufacturers' RV shipments has preceded the last 3 recessions. Guess what? The same thing just happened again. Now this of course could change at any moment. We don't know how it's going to be this time around, but in the last 3 recessions we saw the same pattern existing, and that is going on today. On the left hand side, annual shipments. On the right hand side, you can see the monthly, just giving you an idea of the breakdown of this. It is telling us right here and now that the data that we are presented was very suspicious. We can't highlight any further than that, but what I'm showing you here is the information directly from the source. This comes from the Recreational Vehicle Manufacturers Association instead of from the manipulated government statistics. And then when you present that together in one video like we're doing here, something smells very fishy. This is the commercial bank interest rate on credit cards. We're looking at about 17% today. And you look at the spread in between that and the Fed funds rate. It's never been this great. They usually actually track each other, but that never happened because these credit card companies are gouging the average person. It isn't just necessarily the bottom 50%, but it certainly does hurt them the most. They usually carry a larger percentage here based on their incomes, based on their savings. They don't really have the ability to invest, to save like those in, let's say, the top 10% or the top 20% do. So this is a very different situation for them, and this will really pull down the economy as a result. You can't get away with this for long periods of time. Same situation here. You're looking at the credit card interest rates and the amount of debt used by these people. We're seeing that it is specifically for credit cards nearing $1 trillion worth, and that is truly unbelievable. Even though the interest rate continues to climb, it doesn't matter because as the interest rates increase, people are just going to pay more and more and more. They're only paying the minimum. That's what's very funny because you see that people look at the delinquencies and say, look how low delinquencies are. We don't have a problem. We don't have a problem. But when you look into it deeper, they're paying the minimum. Is that really a way to be a strong consumer? I really don't think so. U.S. consumers' credit card spending is accelerating year-on-year growth comparing the first quarter to the second quarter. All of these companies had seen an increase here and an accelerated pace at which the consumer is putting on credit card debt. If things were fine, they wouldn't use their credit cards. If things were actually going well, they're not going to go further into debt. Yes, they might use their credit cards, but they pay them off. The amount that people are carrying on their balance continues to increase. You're looking at all forms of debt, whether it's their credit card payments, whether it is their car payments, whether it's their any other form of loan. They're basically stretching it out as far as possible. I've shown you the data on that before. Month over month, we are watching people that have to pay more on their typical auto loan payment, and that's not a good thing because they are squeezed to the absolute maximum. That's it for this video. If you found it interesting, if you found it informative, then definitely don't go anywhere until you hit that thumbs up button. Make sure you do so. It supports the channel. If you want the financial education you were not taught in school, these 2 books have everything you need from top to bottom, A to Z. All the details are located in these 2 books. Just hit the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to know what's going on in the economy, the real deal, the information that is not found anywhere else, you got to watch this video. Click on it and I will see you there.